Hey everyone, welcome to our explainer on cost of capital. If you've ever tried to value a company using a discounted cash flow model, you've probably hit a brick wall when the spreadsheet asks for a discount rate, am I right? Look, I get it. The math can look scary, but today we're going to walk through the absolute foundation of DCF models, step by step. Consider me your friendly older brother for the day. We're going to demystify the math so it totally makes sense. Let's dive right in.
So to really grasp why we even need a discount rate in the first place, you've got to answer a super simple, intuitive question about the time value of money. Would you rather have 100 rupees in your hand right now, today, or 100 rupees exactly 5 years from now?
You picked today's money, right? Of course you did. Everyone does. And there are 3 very good reasons for that. First up, time value. Today's money can literally be invested right now to earn interest. Second is inflation. We all know 100 rupees is going to buy you a whole lot less in 5 years than it does today. And third, uncertainty. A lot can happen in half a decade. What if nobody actually hands you that cash? This simple bit of logic proves that any future cash a company makes absolutely must be mathematically discounted to reflect its true present value today. Basically, the higher the risk, the higher the discount rate we're going to demand.
All right, so here's our lesson plan for today. We'll cover CAPM and cost of equity, do a deep dive into beta, look at calculating cost of debt, put it all together with WACC, hit some real-world Indian examples, and finally, wrap up with why this matters for DCF.
Okay, let's start with Section 1, CAPM and cost of equity.
Imagine we're looking at a whiteboard right now, okay? This formula calculates the exact mathematical compensation that you as an investor should demand for taking on the risk of buying a specific stock. It's called the cost of equity. It's simply the risk-free rate plus beta multiplied by the equity risk premium. Let's break those 3 puzzle pieces down.
We can easily translate this formula using 3 very accessible inputs for the Indian market. Step 1 is your risk-free rate. This is your baseline, essentially what you can get with zero risk. Here in India, we look at the 10-year government bond yield, which sits right around 7%. Step 2 is the equity risk premium. See, because stocks are riskier than government bonds, investors historically demand an extra 6 to 7% return just to play in the stock market. And step 3 is beta, which is just a measure of how a specific stock moves compared to the broader market.
Now you might be wondering, where does that 6 to 7% premium actually come from? Well, before we just blindly apply it to Indian equities, let's think about the implied equity risk premium for the US market. Professionals track this forward-looking number obsessively, and it fluctuates constantly based on market prices and expected cash flows. By 2024, it had dropped to around 4.33% in the US. But for emerging markets like India, we typically bump that up to that 6 to 7% range to account for the extra risk. Make sense?
Moving right along to Section 2, deep dive into beta.
So the market as a whole has a beta of exactly 1.0. If a stock has a beta of less than 1, it's considered defensive. Take FMCG giants, companies like HUL at 0.5 or Nestle at 0.4. Think about it. People buy soap and coffee no matter what the economy is doing, right? So they naturally carry lower systemic risk. Then you have your market-like stocks, like HDFC Bank or Infosys, sitting around 0.9 to 1. They pretty much just move with the index. Finally, you have aggressive stocks. Think highly cyclical companies like Tata Steel at 1.5 or those high-growth small caps. With these, you got to strap in because they are significantly more volatile than the overall market.
Let's plug all this back into our formula. Take a super stable, market-like stock like HDFC Bank. It has a beta of roughly 0.9. If we put that alongside our 7% risk-free rate and a 6.5% equity premium, the math comes out to 12.85%. What does that actually mean? It means to invest in HDFC Bank, shareholders intuitively expect a minimum long-term return of 12.85%. And there you have it. That is your cost of equity.
All right, Section 3, calculating cost of debt.
Now, calculating the cost of debt is actually incredibly straightforward. You just divide a company's finance costs by their total debt. But there is one absolute non-negotiable rule you must follow. You have to adjust for taxes. Why? Because interest payments on debt are tax-deductible expenses. The effective cost to the company is actually lower than the actual interest rate they pay out.
Let me show you exactly how that works in the real world. Let's look at Reliance's FY24 numbers. They have massive debt. We're talking around 3.3 lakh crore, and their finance costs tell us their pre-tax interest rate is roughly 7%. But wait,
Because the Indian corporate tax rate is 25%, Reliance gets a tax shield. So we multiply 7% by 1 minus 0.25, and their effective after-tax cost of debt drops down to a very cheap 5.25%. Pretty cool, right?
Okay, Section 4. Putting it together, WACC. Please, whatever you do, do not let this giant formula intimidate you. I know it looks like alphabet soup, but it's really just a simple blending machine. Literally, all we are doing is taking our equity cost and our debt cost and weighting them based on what percentage of the company is funded by equity versus what percentage is funded by debt. That's the whole shebang.
Let's see how this builds for Reliance. Their total capital is a massive 22.3 lakh crore. Based on market values, they're funded by roughly 85% equity and 15% debt. From our previous math, we know their cost of equity is 14.15% and their after-tax cost of debt is 5.25%. So we just multiply the weights by the rates, 85% times 14.15% plus 15% times 5.25%, and boom, we arrive at a master WACC of 12.8%. This right here is the magic number. It literally means Reliance's future projects need to generate at least a 12.8% return just to create value.
Let's move to Section 5, Real-World Indian Examples.
Let's look at the IT giant TCS. What's super unique about TCS? Well, they have almost zero debt. Because they don't use debt financing, their WACC calculation is a breeze. It's essentially just their cost of equity. Because of their incredibly stable 0.8 beta, their overall cost of capital sits beautifully at exactly 12.2%.
The really big takeaways you need to internalize here are all about capital structure and risk. If a company adds debt, kind of like Reliance does, it actually lowers their overall WACC. Why? Because debt is much cheaper than equity, all thanks to that tax shield we just talked about. On the flip side, if you're looking at a highly volatile, cyclical stock like Tata Steel with a beta of 1.5, that high risk drives their cost of equity up, and therefore their overall WACC goes way up, often pushing your 16 or 17%.
Finally, Section 6, why this matters for DCF.
So here is the ultimate payoff for all this math. Our calculated WACC is the exact discount rate, often denoted as R. That sits right at the bottom of the discounted cash flow formula. If we project that Reliance is going to generate 50,000 crore in cash next year, we can't just value that at 50,000 today. We have to divide it by 1 plus our WACC of 12.8%, which means that 50,000 crore next year is worth exactly 44,326 crore today. You do this for 10 years of cash flows, sum them all up, and you have the intrinsic value of the entire company.
So when you go off to build your own DCF models, keep your inputs simple and grounded. Use the 10-year GSEC yield for your risk-free rate, grab Aswath Damodaran's updated equity risk premiums for India, and pull your stock betas from free sites like Screener.in or Yahoo Finance. Generally, expect most Indian large caps to have a WACC ranging from 11 to 15%. My absolute biggest piece of advice here, don't get overly fancy. Don't chase decimal point precision. Valuation is always an estimate, so just use sensible ranges.
Always remember, the discount rate is the bedrock of absolute valuation. If you rush through this part and your WACC is fundamentally wrong, it literally doesn't matter how amazing your revenue projections are, your entire valuation will be completely busted. So be patient with these foundational building blocks. Getting the cost of capital right is the only true way to find a company's intrinsic value.
Well, you've just conquered the hardest math and valuation and built a solid foundation for absolute DCF modeling. Awesome job. But I want to leave you with this final provocative thought. What if you don't want to forecast 10 whole years of cash flows? How do we easily and quickly compare HDFC Bank directly to ICICI Bank using the market's current pricing? Well, that requires multiples like PE and EV to EBITDA. And that is exactly the puzzle we're going to solve in our next explainer. Thanks so much for hanging out with me today. Keep practicing those formulas, and I'll catch you next time.